The theme of our presentation this year is focusing on the long term and staying in the long game long enough to let compounding do its thing. This means avoiding blowups. And before I get into the slide, I want to take a moment to recognize Sam Zell, who recently passed away. I had the honor of interviewing him on 2 separate occasions, and he's a real mensch. Sam was the grandfather of the modern REIT, and I learned the lesson of focusing on supply and demand from him. He was hugely philanthropic, liked to enjoy life, and didn't take himself too seriously. There was a lot we can learn from the way he conducted his life. Instead of handing out business cards, Sam handed out a little red book with cartoon drawings and quotes of what he called Samisms. Let's see what this one's telling us. It's good to be a risk taker, but you need to do it on your own terms, where you focus on managing the downside and go into deals with higher probabilities of success. Sam's lesson here is key to the way we approach things at Foremost, and is a perfect example of how we focus on delivering consistent results over the long term. So now I'm going to get into a few of our thoughts at Foremost. We're calling this part Surviving a Sea of Change. Surviving, we said that the theme is long-term compounding. To compound for the long term, you need to survive various environments. Sea of Change will make more sense once we get into our slides, but we're going to present something by Howard Marks called Sea Change, so that'll make a little more sense. So long-term compounding. Buffett says, "My life has been a product of compound interest," and his partner Charlie Munger says, "The first rule of compounding is never interrupted unnecessarily." So what's interesting with Buffett's, if you look at the chart here, this is the quintessential compounding curve. What you can see is that Buffett started investing at a very young age, and he compounded at a subhuman rate of return. It's very hard to compound at the rate that he's compounded at. But what was interesting to me about the slide is that at age 60, with only $3.8 billion, most people would probably say, I'm just going to retire, right? That's enough money. Buffett didn't, and he kept on going, and that's when the compounding really became exponential. So when you look at this curve over his lifetime, it really looks like he was kind of sucking wind for quite a long time before his wealth really exploded. And that's what's so hard about compounding for the long term. You need to ride through the beginning part of the compounding curve, which is much flatter. Interestingly, 95% of Buffett's net worth came after the age of 60. He's been blessed with a long enough life that he's had many compounding periods. And another thing I found interesting is that Charlie Munger is worth about $3 billion, and he's worth so much less than Buffett because he started in his early 40s. He practiced law before, and Buffett started in his teens. So it's a lesson to all of us to start investing early and to keep going. Don't interrupt your compounding. So on the theme of long-term compounding, the interesting thing about the business we play in is that we're lucky to be playing in a game where the odds are in our favor. Real estate over time always goes up. The problem is you need to survive the short-term dips, because there are periods when real estate goes down. Because the game is in our favor, real estate attracts a lot of capital and a lot of leverage. This makes people a lot of money and makes them look smart most of the time. However, when the economy goes into recession and real estate values go down, the leveraged players blow up. So really, it's our job to structure our affairs to account for the inevitable dips, leave some risk and return on the table, and make sure that we survive to be able to keep on compounding for the long term. All right, now we're going to talk about Howard Marks' Sea Change. Sea Change basically implies that there's been a change in regime, that the way things have been for quite a while have shifted. And in December of last year, Howard Marks published a piece of paper it was a game changer, and the theme was basically sea change, a game changer. And he thought that this was happening right now in the investing world. So Marks, just to prove why you should pay attention to him, he's a multi-billionaire credit investor who's been managing money for more than 50 years. And he's arguing that we've had a 40-year environment where interest rates have been declining, which you can see in the graph on the right. The green is basically the interest rate trend for 40 years. And the little red arrow is what's happened now, which is interest rates have gone up. In a declining interest rate environment, it leads to a period of rising asset prices, because asset valuations are predicated on discounting a stream of future cash flows. And when interest rates go down, discount rates go down, which results in a willingness to pay a higher price. It is Marks' position that this regime is likely changed. He fully admits that he cannot predict markets, but he does feel that he needs to take the temperature and know where we are today. And today he feels like the Fed cannot return to stimulative policies, and that the base interest rate is more likely to be 2 to 4% than 0 to 2%. And if you believe Marx, then it has big implications for how your capital should be allocated. So I love this chart on the right. I'm calling it a temperature check. Basically, Marx believes that investors in credit instruments will be well rewarded, and there will be wonderful opportunities for lenders going forward. You can see this when you look at our first mortgages that are now earning more than 10% after a period of being in the 7% range. So just to take a quick look at the table on the right, it provides some insight into why he feels lenders will have good opportunities. Essentially, the temperature has changed. Things are no longer 28 degrees and sunny. Ultimately, this should lead to a reduction in the availability of capital, which creates risks, but also great opportunities for smart investors. So if you look at the table, it compares, the middle column is basically after the financial crisis when there was quantitative easing, so 2009 to 2021, and then how that compares to today. So if you look at them quickly, the Fed's behavior was highly stimulative, now they're tightening. Inflation was dormant, now it's a 40-year high. The economic outlook was positive, now recession is likely. The likelihood of distress was minimal, now it's rising. The mood was optimistic, now it's guarded. Buyers were eager, now they're hesitant. Holders were complacent, now they're uncertain. The key worry was fear of missing out, now the key worry is investment losses. Risk aversion was absent, now it's rising. The credit window was wide open, now it's constricted. Financing was plentiful, now it's scarce. Interest rates were the lowest ever, now they're more normal. And yield spreads were modest, now they're normal. So he's just trying to take a look at the whole picture together and see what story it's telling him. So what does all this mean? We think that as liquidity tightens up, institutional capital leaves the lending ecosystem, risk appetites decline, and it becomes harder to finance projects. This creates a huge opportunity for private lenders to fill the void. We'll dig into this point a bit later. It also creates great opportunities for real estate equity investors, and we'll give you some examples of the opportunities we've secured at prices well below replacement values with high target returns. If you believe we're living through sea change, then it becomes increasingly important to determine how to allocate your capital in this environment. We would suggest you consider giving your capital to managers with very strong management teams whose values align with yours and who focus on the long term. These managers should have lived through various cycles and should be most concerned with managing downside risk. Hopefully you consider us to be one of those kinds of managers.